Hello everyone, and thanks for watching Edupedia Word videos. This chapter is entitled The Demand for Money. In this video, we are going to talk about the motives for holding money. Then, we are going to find out the expectations of changes in the prices of securities and other assets. After that, I will present you an exercise. Then, we will have a look at the maths. So, let's get started. The demand for money refers to the desire to hold money, to keep your wealth in the form of money rather than spending it on goods and services or using it to purchase financial assets such as bonds or shares. It is usual to distinguish three reasons why people want to hold their assets in the form of money. Note that we are talking here about broad money, M4, in the United Kingdom. The first motive is called the transactions motive. Since money is a medium of exchange, it is required for conducting transactions. But since people receive money only at intervals, for example weekly or monthly, and not continuously, they require to hold balances of money in cash or in current accounts. As for the precautionary motive, in fact, unforeseen circumstances can arise, such as a car breakdown. Thus, individuals often hold some additional money as a precaution. Firms do keep precautionary balances because of uncertainties about the timing of their receipts and payments. If a large customer is late in making payment, a firm may be unable to pay its suppliers unless it has spare liquidity. The third motive is called the speculative or assets motive. Certain firms and individuals who wish to purchase financial assets such as bonds, shares, or other securities may prefer to wait if they feel that their price is likely to fall. In the meantime, they will hold money balances instead. The speculative demand can be quite high when the price of securities is considered certain to fall. Money, when used for this purpose, is a means of temporarily storing wealth. Similarly, people who will require foreign currency at some time in the future, people such as importers, holiday makers, or those thinking of investing abroad or in foreign securities, may prefer to wait before exchanging pounds into the relevant foreign currencies if they believe that the sterling price of these currencies is likely to fall. So the pound is likely to appreciate. Let's talk about the transactions plus precautionary demand for money, the famous L1. The transactions plus precautionary demand for money is termed L1. L stands for liquidity preference, that is, the desire to hold assets in liquid form. Money balances held for these two purposes are called active balances, money to be used as a medium of exchange. What determines the size of L1? The major determinant of L1 is nominal national income, that is to say, national income at current prices. The bigger people's money income, the greater their expenditure and the bigger their demand for active balances. The frequency with which people are paid also affects L1. The less frequently they are paid, the greater the level of money balances they will require to tide them over until the next payment. The rate of interest has some effect on L1, albeit rather small. At high rates of interest, people may choose to spend less and save more of their income, or, for example, by buying shares. The effect is likely to be bigger on the precautionary demand. A higher interest rate may encourage people to risk tying up their money. Firms' active balances are more likely to be sensitive to changes in R than those of individuals. Other determinants of L1 include the season of the year. People require more money balances at Christmas, for example. Also, any other factors that affect consumption will affect L1. The increased use of credit cards in recent years has reduced both the transactions and precautionary demands. paying once a month for goods requires less money on average than paying separately for each item purchased. Moreover, the possession of a credit card reduces or even eliminates the need to hold precautionary balances for many people. On the other hand, the increased availability of cash machines, the convenience of debit cards, and the ability to earn interest on current accounts have all encouraged people to hold more money in bank accounts. The net effect has been an increase in the demand for borrowed money. What about the speculative demand for money, L2? The speculative demand for money balances is termed L2. Money balances held for this purpose are called idle balances. People who possess wealth, whether they are wealthy or simply small savers, have to decide the best form in which to hold that wealth. Do they keep it in cash, in a piggy bank, or in a current account, in a real bank? Or do they put it in some interest-bearing time account? Or do they buy stocks and shares or government bonds? Or do they buy some physical assets such as a car or property? In making these decisions, people will have to weigh up the relative advantages and disadvantages of the various alternative assets. Assets can be compared according to two criteria: liquidity and the possibility of earning income. Just as we saw in the case of a bank's assets, these two criteria tend to conflict. The more liquid an asset is, the lower is likely to be the income earned from holding it. Thus, cash is totally liquid to the holder. It can be used to buy other assets or spent on goods instantly, but it earns no interest. Stocks and shares, on the other hand, are not very liquid since they cannot be sold instantly at a guaranteed price. They can be sold pretty well instantly, but if share prices are depressed, a considerable loss may be incurred in so doing. In other words, they are a risky means of holding wealth, but stocks and shares have the potential of earning quite a high income for the holder, not only in terms of the dividends paid out of the firm's profits, but also in terms of the capital gain from any increase in the shares prices. There are three major determinants of the speculative demand for money. Let us examine each in turn. The rate of interest or rate of return on assets. The higher the rate of return on assets, such as shares and bonds, the greater the opportunity cost of holding money, and therefore the lower the speculative demand for money. The rate of return on assets varies inversely with their price. Take the case of a government bond, which pays a fixed sum of money throughout its life. Assume that the government issued a 100 euros bond at a time when interest rates were 10%. Thus, the bond must pay 10 euro per year, although the government will not redeem bonds until their maturity date, which could well be 20 years from when they were issued. Holders can sell bonds at any time on the stock market. Their market price will reflect market rates of interest. Assume, for example, that interest rates fall to 5%. What will happen to the market price of the bond paying 10 euro per year? It will be driven up to 200 euros. At that price, the 10 euro per year is worth the current market rate of 5%. Thus, the market price of bonds varies inversely with the rate of interest. What about the expectations of changes in the prices of securities and other assets? Well, if people believe that share prices are about to rise rapidly on the stock market, they will buy shares and hold smaller speculative balances of money. If they think that share prices will fall, they will sell them and hold money instead. Some clever, or let's say lucky individuals anticipated the 2000-2003 stock market decline. They sold shares and went liquid. Some people made a similar move in the stock market decline of 2007-2008. If the market price of securities is high, the rate of interest, that is to say, the rate again of return on these securities will be low. Potential purchasers of these securities will probably wait until their prices fall and the rate of interest rises. Similarly, existing holders of securities will probably sell them while the price is high, hoping to buy them back again when the price falls, thus making a capital gain. In the meantime, therefore, large speculative balances of money will be held and L2 is high. If, on the other hand, the rate of interest is high, then L2 is likely to be low. To take advantage of the high rate of return on securities, people buy them now instead of holding on to their money. The relationship between L2 and the rate of interest R is again shown in this figure. The inverse relationship between R and L2 gives a downward sloping curve. Let's move to talk about the speculative demand and the exchange rate. In an open economy like the UK, where large-scale movements of currencies across the foreign exchanges take place, expectations about changes in the exchange rate are a major determinant of the speculative demand for money. If people believe that the pound is likely to appreciate, they will want to hold sterling until it does appreciate. For example, if the current exchange rate is €1 equals $1.5 and speculators believe that it will shortly rise to €1 equals $1.75, then if they are correct, they will make a 25 cents per €1 profit by holding sterling. The more quickly is the exchange rate expected to rise, the more will people want to hold sterling as money. If, however, people believe that it will be a slow rise over time, they will want to buy sterling assets such as UK government bonds rather than money, since such assets will also earn the holder a rate of interest. Conversely, if people believe that the exchange rate is likely to fall in the near future, they will economize on their holdings of sterling, preferring to hold their liquid assets in some other currency, the one most likely to appreciate against other currencies. Graphically, changes in expectations about the exchange rate will have the effect on shifting the L2 curve in this figure. There is a further complication here. Expectations about changes in the exchange rate will themselves be influenced by the interest rate relative to overseas interest rates. If the UK rate of interest goes up, people will want to deposit their money in the United Kingdom. This will increase the demand for sterling on the foreign exchange market. There will be a short-term financial inflow into the UK. The financial account of the balance of payments will go into surplus. The effect will be to drive up the exchange rate. Thus, if people believe that the UK rate of interest will rise, they will also believe that the rate of exchange will appreciate, and they will want to hold larger speculative balances of sterling. The introduction of the foreign exchange dimension into our analysis will have two effects on the L2 curve. First, the curve will become more elastic. If the rate of interest is low and is thought likely to rise, the speculative demand is likely to be very high. Not only will people hold money in anticipation of a fall in security prices, but they will also hold money, that is to say sterling in our case, in anticipation of an appreciation of the exchange rate. Second, the curve will become more unstable. Indeed, expectations of changes in the exchange rate do not just depend on current domestic interest rates. They depend on the current and anticipated future state of the balance of trade, the rate of inflation, the current and anticipated levels of interest rates in other major trading countries, the price of oil, and so on. If any of these cause people to expect a lower exchange rate, the speculative demand for money will fall, so L2 will shift to the left. Now, let's examine this exercise. Which way is the L2 curve likely to shift in the following cases? A. The balance of trade moves into deficit. B. People anticipate that foreign interest rates are likely to rise substantially relative to domestic ones. C. The domestic rate of inflation falls below that of other major trading countries. And D. People believe that the pound is about to depreciate. Now let's move to talk about the total demand for money, L1 plus L2. This figure also shows the total demand for money balances L. This is found by the horizontal addition of curves L1 and L2. This curve is known as the liquidity preference curve or simply the demand for money curve. Any factor other than a change in interest rates that causes the demand for money to rise will shift the L curve to the right. For example, a rise in national income will cause L1 to increase, and thus L will shift to the right. What about the additional effects of expectations? We have talked about expectations and their importance in determining the speculative demand for money. In particular, we have looked at the effect of interest rates on people's anticipations of future securities prices and the effect of expectations about exchange rate movements. There are two other ways in which expectations can influence the demand for money and make it more unstable. The expectations about prices. In fact, if people expect prices to rise, they may reduce their money balances and purchase goods and assets now before prices do rise. This will tend to shift L to the left. Note here that once prices have risen, people will need more money to conduct the same amount of transactions. As for the expectations of interest rate levels over the longer term, if people come to expect that interest rates will normally be higher than they used to be, then any given interest rate will seem lower relative to the normal rate than it used to be. People will be more inclined to hold speculative balances of money in anticipation of a rise in interest rates, and this will tend to shift L upwards. Now let's have a look at the maths. The demand for money L can be expressed by the following function. Number 1, L equals L1 plus L2. This states that L1 is a function of nominal national income, that is to say, a real national income Y multiplied by the price index P, the frequency with which people are paid F, and the nominal rate of interest I, which equals the real rate of interest R on alternative assets to money plus the expected rate of inflation PE. L2 is a function of the nominal rate of interest I and the expected value of the exchange rate ERE. The advantage of specifying a relationship in this way is that it gives a simple way of representing a situation where something depends on a number of determinants. It is a convenient shorthand. Indeed, a more complex function could easily be specified where the demand for money depends on a longer list of variables. The one above, however, identifies the main determinants. By putting plus and minus signs under each of the terms, we could also identify whether the relationship with each of the determinants is a positive or a negative one. That is to say, whether the respective partial derivative is positive or negative. So equation 1 could thus be written as shown in 2. This merely states that the demand for money will rise as PY and ERE rise and F and I fall. In an era of uncertainty about inflation, interest rates and exchange rates, people's expectations will be hard to predict. They will be volatile and susceptible to rumors and political events. In such circumstances, the L curve itself will be hard to predict and will be subject to considerable shifts. Generally, it is likely that the greater the uncertainty, the greater will be the preference for liquidity and the greater the risk of tying wealth up in liquid assets. Now, let's move to the section summary. We saw that the three motives for holding money are the transactions, precautionary, and speculative or assets motives. We also saw that the transactions plus precautionary demand for money, L1, depends primarily on the level of the nominal national income, the frequency with which people are paid, and institutional arrangements, such as the use of credit and debit cards. It also depends to some degree on the rate of interest. The speculative demand for money, L2, depends on the rate of return on assets and on anticipations about future movements in security prices, and hence their rate of return, and future movements in exchange rates. If security prices are anticipated to fall or the exchange rate to rise, people will hold more money balances. Eventually, the demand for money is also influenced by expectations of price changes and the levels of interest rates over the longer term. So this is the end of this video. The next chapter will be entitled Equilibrium. Thank you very much for your attention.